Welcome to the Allan Small Financial Show. As always, I want to thank all of you for taking the time out of your busy day to spend it with us. It's funny, before I came on air right now, I was talking to my team and saying how much information we have on the show to present to all of you today. We have information on corporate earnings. We're going to talk about some macro data out of the US and even some out of Canada. We also have a fantastic guest talking to us about artificial intelligence. So a jam-packed show full of a lot of information, kind of information overload. So hopefully all of you will be able to take something out of today's show. Let's put up our list of topics for today. Our first segment, we will be talking about understanding artificial intelligence, an interview with Bob Tapscott. Bob is an author and strategist. He has been a consultant to some of the world's largest companies, CEOs from some of the world's largest companies. He talks a bit about, emerging technologies. He has given speeches and talks on artificial intelligence. And I had the chance of catching up with him over the past week and talking to him about artificial intelligence. And we're going to bring you that interview this afternoon. As usual, we'll talk about our top 3 things to consider over the next 10 business days. I think these are very important for everyone to consider before you make your investment decisions. Taking stock of the market and the economy. So where do things stand right now? Well, today is May 1st. We've now gone through 4 months in 2024, so a third of the year right now. And where do things stand? How are the markets faring? Heading into May, what do the markets look like at this point? We'll touch on that. U.S. GDP drops more than expected. We just recently received the GDP number out of the U.S. We were expecting to see something in the vicinity of 2.5%, and we saw a number of 1.6%, a significant drop-off in growth out of the U.S., the first one that we've seen. Now, we've seen us here in Canada, the drop-off a little more substantial, a little sooner, but maybe we're starting to see growth slow down in the U.S. Companies reporting good earnings and still selling off after they report earnings. Why is this happening? There's a phenomenon that tends to happen when companies sell off. We always say you buy the rumor and sell the news. Well, definitely the investors, for many investments, unfortunately, have been selling the news, selling on the news, even though the news was pretty darn good. Budget commentary. I know I've been getting a lot of calls, a lot of messages regarding the budget and our government talking about how it only affects 0.1% of the population. Well, I'm going to tell you that is not true. It affects a lot more people than just 0.1%. And I've been talking to a lot of investors, a lot of professionals who have incorporated, and they feel as though they've been, targeted by this latest increase in capital gains tax and the inclusion rate rising for many, a lot more than 0.1%. So we'll touch on that as well. And lastly, your questions. If you have any questions during the course of the show, on the interview with Bob Tapscott, or anything I discuss, please put it in the chat boxes while you're watching the show. I'd be happy to address some of the questions at the end of the show, or perhaps I will return those messages during or over the next couple of weeks until our next show, or as always, maybe address them on our next show as well. So without further ado, let's get on with the show and our interview with Bob Tapscott. I'd like to welcome international speaker, author, and strategist Bob Tapscott to the show. Bob has keynoted conferences on artificial intelligence, fintech, and blockchain. He recently launched a book called Trivergence, Accelerating Innovation with Artificial Intelligence, Blockchain, and the Internet of Things. Bob Tapscott, welcome to the show.
Thank you. It's a pleasure to be here.
It's great having you as our expert in artificial intelligence. Obviously something that many people have gotten a little bit more familiar with over the past, let's call it many months now. I guess ChatGPT, when that came into our lives, Microsoft bringing it to our life a little while ago, it looks like that's when people really started to jump on the AI bandwagon. And so what is artificial intelligence? How does artificial intelligence affect the way we live today, affect the way we do business? How do you see it affecting our lives in general in the future?
Well, if we can go back a bit, artificial intelligence may be new to the consumer marketplace, but there have been attempts to get a computer to think like humans going back to the 1940s. The one that's rocking the world is based on how neural networks in the brain actually function. It was first envisioned way back in the 1940s, and it has been tried and failed for many, many decades. However, at the beginning of this century, three professors from various universities found a way to make them smarter. What also happened was a revolution in hardware architecture based originally on graphics card, then funded heavily by Bitcoin mining, in which you have a massive array of GPUs performing a particular function that can be performed in parallel. What was a great architecture for graphics and a great architecture for mining Bitcoin is also a perfect architecture for neural networks and artificial intelligence. So historically, the speed of computers was predicted, if not limited, by Moore's law, which said that the number of transistors on a chip doubled about every 2 years. But what happened? What typically in a decade was 1,000-fold increase in throughput, and the last decade has been a million-fold increase in throughput. So suddenly we have a new architecture which has sped up computers by an order of magnitude, not one order of magnitude, 6 orders of magnitude. You've got new approaches as a result of those three professors. And from the Internet of Things, you have a ton of data on which the new approaches to artificial intelligence can thrive.
How would you say it is already affecting just the average person in their day-to-day life?
Well, I think for this decade, you're going to see AI become, a friend, an associate, a helper in terms of any conceivable job you have, from creating music to scientific research to medicine to writing an essay. It's going to be very helpful. And I think in 3 or 4 years, everyone is going to have AI on their desk. Through that process, it's going to gain a heck of a lot more data. And we're going to see in the 2030s the ability of AI to move off of your desk and fundamentally into your chair.
If I wanted to think about artificial intelligence and all the things that we hear that it's going to do, is it just going to one day just pop up at the office and all of a sudden your search engine or your certain functions in the office will be a lot different, a lot quicker and more efficient?
I think you're going to find that it's employed in corporations on a massive scale and very quickly. So, depending on what you do, I mean, if you write a book, it can generate a framework for that book. If your job is in terms of customer service, as you've seen with these chatbots, is that almost every company has a AI chatbot before you can get to a human being. And once again, that chatbot is as good as the amount of data that it has. So companies that have a history of all the data associated with chatbots with people have a distinct advantage in terms of coming up with one that's AI based, that is as good as and soon better than humans will be.
I guess the AI itself is as good as whatever it's programmed or whatever information is programmed into it. And I guess over time, is it fair to say that these computers or chips or whatever we're talking about learns from, I guess, the information that I guess a human will program it with or for?
They are programs, certainly, but they derive their logic not from if then else statements, traditionally, as have computer systems. They derive their intelligence from data. And in some ways, that makes them infinitely more powerful. So, for instance, ChatGPT 4 is referenced or is assumed or guessed to have trillions of data points. And where it's got its data was from reading the New York Times, any book it could read online, probably including my book, and everything that has been digitized. And so the good news, it has that vast experiential database. And the bad news is there are things on the internet that are not true. So in some ways, it's going to come to the right conclusions a certain percent of the time, and it's definitely going to come to the wrong conclusions another percentage of the time.
Obviously, we're a financial show. We try to bring financial information to investors every few weeks. If you were to put on your investment hat, what would you say would be the better way to invest in artificial intelligence? Would you be more inclined to be investing in an NVIDIA, which we all know as the big company that I guess is creating the chips, or maybe even an AMD, which is perhaps an up and coming challenger? Or would you be more inclined to invest in Meta or Microsoft or Alphabet, companies that are going to be using chips to better their I guess, their services? What would you say would be the better investment?
One of the things that's occurred in technology, and it's occurred for 50 years, is in the beginning, WordPerfect was better than Word, and Lotus 123 was better than Excel. But eventually, what happened is then in a department, people standardize on a particular product, and then it happened within a company, and then it happened within the industry, and then it happened within the world. And because he who has the largest and best database has the most intelligent AI system, I suspect that they will get more customers and they will get more data and become an even more intelligent system. So the tend towards consolidation and ending up with few players in AI seems like an inevitability. So, in terms of hardware, that's the shovels of Bitcoin mining, and it's the shovels underneath AI. So, I think those are reasonably safe bets. And in terms of software companies, the big players are the only ones that can afford to have systems that literally can scrape the entire internet. So, there are definitely winners there. And the other winners, in which I think you're going to see some phenomenal results, are companies that employ these new techniques on a very limited area, be it in medicine or be it in driving or be it in wherever, that with a limited amount of data, without the massive CPU complexes that, say, Google has, are able to come up with a groundbreaking application.
Thought we'd end off our interview talking a bit about your book, Trivergence, Accelerating Innovation with AI, Blockchain, and the Internet of Things. So I guess just tell us, who's this book for, and what are you attempting to answer when you made the book?
I wanted to explain that the three forces that are triverging uh, to mean that the explosive power that they're unleashing is happening now, and it's coming at us, say, much faster than the Industrial Revolution. The transformation is going to be profound. So I wanted to accomplish a couple of different things. One is explain why now, why it's going to happen so quickly, and why I'd say in a 10 or 12-year period is everything from medical research to education to work is going to be radically transformed. So I wanted to explain that that's going to happen and put a framework in place in terms of how we as a society may adapt to this. And what I also hope to do was that, like every transformation, every major disruption, there are going to be people who hold on to the old paradigms and get obsolesced in the process. And there are going to be people who understand the potential of these new technologies and are going to be able to ride this very large wave. And I was hoping that this book would position people to be in the latter category.
Well, I think it's going to be well, it is a very informative book, I think, for those that would like to read it. Obviously, you have a tremendous amount of experience in the area. And Bob Tapscott, I want to thank you today for joining us and shedding some light on this, I guess, opening box called artificial intelligence. I don't want to say a black box because we're learning more and more about it. The average person walking the street is asking me more and more about how they can invest in the area of artificial intelligence. And I think we've given everybody a nice little glimpse as to what it is and how powerful it's going to be in the years to come and how it's going to revolutionize the way we live. So, Bob, thank you again for being on the show. It was a pleasure having you.
My treat. Thank you so much.
Thank you. That was a great interview with Bob Tapscott talking about AI, and I guess a great talk, a little bit scary in that I think he had said that over the next 5 to 10 years, AI, artificial intelligence, will be a helper and assistant that will sit on our desks to help all of us. And then by the 2030s, it'll go from the top, sitting on top of our desks to actually in our chair. So does he mean replace us? That's the fear I think many people have. AI perhaps at some point will begin, if not already, to start to begin to replace to jobs that people hold. So a scary thing, but hopefully AI will also produce new jobs for many going forward. So now the part of the show that I talk about what I believe is important for individual investors to consider over the next 10 business days. So 3 things that I think are important for individual investors to consider over the next couple of weeks. And you can see them here. They are Fed speak. Federal Reserve has a meeting today, 2 p.m. They'll talk about interest rates and interest rate setting policy. Corporate earnings. We're in the heart of corporate earnings. This week is actually the busiest week for corporate earnings in the United States. And we're obviously about halfway through. Lastly, but definitely not least, economic data. Looking at data from 30,000 feet. So we're talking about macro data and how that will affect the stock market and stock market movements. So the first topic, or I guess point, Fed speak. And I thought I'd start with Fed speak, as I said, because today we do have a meeting at 2 p.m. The Federal Reserve will announce what they're going to do with interest rates. Now, I don't believe anybody believes that they will cut interest rates today, nor will they raise interest rates today either. But I think we're all going to be listening for where the bias lies. Will the Fed still say that they're waiting to cut rates and it's still only a matter of time, and based on economic data, the next move in interest rates will be to the downside? Or will they say for the first time in quite some time that they could actually consider raising interest rates because inflation in the US has been or has remained stubbornly above their 2% target? So a lot of people are going to be looking for what the Fed says. Will they be hawkish, leaning more towards keeping things where they are, higher rates for longer, or maybe even an interest rate increase? Or will they hint or continue to talk about a point in time where they can cut rates because interest rates definitely are on the high side, especially when you consider interest rates in the US, Fed funds rate above 5%, when inflation, even though it's been creeping up, still below 4%. So there is still a pretty large gap there. So it'll be very interesting to see what the Fed says, but not only just the Fed governors in general. Once the Fed speaks today at 2 p.m., all the Fed officials will be free to go to the press. All the different Fed heads from all the different offices across the United States, Chicago, San Francisco, New York Fed, they'll talk about what they believe and what they think is important with respect to interest rates. So first chart that we have here, Fed funds target rate. We've shown this in the past. You can see pretty much a spike higher over the past couple of years. And I would say over the last 6 months to 12 months, you've seen a flattening out, no more interest rate increases. And we haven't seen any interest rate decreases as yet. But because Fed officials have been saying that inflation has remained stubbornly high, even though it's come down from 9% in the US, they're still not happy because they want to see a 2% inflation rate. And until they see at least a path to 2% or things moving towards 2%, they're not about to lower interest rates. A second and third chart, actually, we have charts together with respect to, well, you can see it here, the dream of Fed interest rate cuts slipping away. And that's mainly for this year, I would say. Hopefully, we can still see at least one, maybe squeeze in a second interest rate cut, but it's looking less and less likely. And perhaps interest rate cuts may not happen until 2025. On the left-hand side of the chart, you can see real GDP growth in the 2023 staying very, very high. you could see that in the latter half of the year, GDP really spiked higher. In 2024, in the beginning of the year, you can see it coming down, but still staying in between 1.5%, 2%. GDP in our country has been coming in at around 1.5% for a little while now. Predictions are actually that we will see perhaps maybe even a 2.5% GDP growth number this year. So again, maybe that gives the Bank of Canada some time before they want to cut rates as well. On the right-hand side of this chart, which I think is more important than the left, is core PCE. Remember, PCE is basically a measurement that the Fed uses to look at inflation, personal consumption and expenditures. That's what it stands for. It doesn't really factor in as much of the shelter prices as CPI, Consumer Price Index, does. So it takes away a little bit of the shelter, which we know shelter housing prices have been really high. And you can see here that core PCE year over year is still sort of coming down, maybe flattening out. That's the lighter line. And the darker line, the blue line, is more on a quarterly change basis, quarterly change annualized. And you can see how it shot up recently. So with that in mind, I don't believe that the Fed will be in a position or wants to be in a position to cut rates. Well, I should say they want to be able to cut rates, but don't think that they will be in a position to do so over at least the next few meetings. We're now seeing that an interest rate cut may not happen until all the way to December. And December is the first time we see the chances above 50% that we will have a rate cut. So let's hear what the Fed says at 2 o'clock today. Let's try and parse through what Fed officials will say in the coming weeks after the news release this afternoon, interest rate setting policy this afternoon. And I think individual investors need to be mindful of that. The second point I wanted to touch on is corporate earnings. And as I said, we are in the heart of corporate earnings. And if you have a diversified portfolio out of different types of stocks and bonds and mutual funds, perhaps, et cetera, you're looking at what these companies are reporting. And for the most part, corporate earnings have been really, really good. And we've seen a number of the big cap tech names come through with good earnings. A couple of them disappointing earnings. Tesla comes to mind on the disappointing earnings side. But for the most part, the other big cap Magnificent Seven names have really done well. And we're seeing really companies right across the board do well, not just in tech. We're seeing on average 70, 75% of the companies that have reported are beating expectations. So that's a good thing. We have a couple of charts here to show you. One is Alphabet, or we know it as Google, at least I still call it Google. And you can see here that that spike that you see on the right-hand side of the chart, that is right after they reported earnings. And if you're wondering why you see a downward trend, well, that was more to do with macro data that came out, inflation data that was a little warmer that came out right after the earnings. So we saw a spike in Google, reported phenomenal earnings, probably the best earnings out of any company that I've seen so far for this quarterly reporting season. And unfortunately, the macro data took down their price a little bit, but still above where it was prior to the corporate earning, prior to them releasing corporate earnings. A second chart we have here, Eli Lilly. Now, for those of you that don't know Eli Lilly is a U.S. pharmaceutical company. You may have heard that them, along with other company, Novo Nordisk, Ozempic, perhaps that rings a bell. They're into the weight loss drugs. Originally started off as diabetes drugs, but then quickly realized that people can lose weight if they're on these drugs. And they started to make versions of the drug specifically for weight loss. And Eli Lilly has never looked back, has shot up. And we're starting to learn that these drugs can also be used for things such as addictions, drug addiction or alcohol addictions. And so we're starting to hear that Eli Lilly is getting into that area of research. So a lot of things coming down the pipe in Eli Lilly, diabetes drugs, weight loss drugs, Alzheimer's. They're looking at that as well as a possible drug to slow down Alzheimer's in general. So Eli Lilly, you can see how well the stock has done. You can see here up $42 on the day it reported earnings. Some are actually calling Eli Lilly the Nvidia of pharmaceuticals, of the pharmaceutical sector, because how fast it's gone up. Almost $1 trillion market cap, by far the largest pharmaceutical company in North America, one of the largest in the world today, if not the largest. So corporate earnings, very important. We've seen a lot of companies do well, and a lot of companies, unfortunately, not do well. Starbucks comes to mind. They reported earnings not so well. McDonald's, not so well. CVS, the pharmacy company in the United States, really disappointing earnings. Saw their stock fall more than 15%. So again, we do have, I guess, a mix of those doing well, those that are not. Some of them are in the same sector, Eli Lilly, Pfizer, Pharma, that's doing well. And then there are some that haven't done as well. So corporate earnings is something that I think individual investors obviously need to focus on. The third point and last point I wanted to make is economic data. What is the economic data individual investors need to focus on? Well, a lot of economic data has come out recently. We've seen, as I said, GDP falling down to 1.6% in the US. But coming up on Friday, we're going to have a big report. It's the jobs data. And that's the first thing I wanted to discuss. Job creation in the US. We saw in the month of March, job creation was above 300,000. We have a chart that shows you the job creation in the US, monthly jobs. There you have it. And you can see that in March, it had the highest number. You can go back all the way, I guess, into the spring of 2023. So a year ago, since we saw such strong job creation for the month of March. Individuals are expecting jobs growth to become slower in the US. We saw what we call ADP, private payrolls today out of the US, again, beating slightly on the expectations. So we'll see what the jobs number reports or what the jobs number tells us on Friday, but it will definitely be a market mover. If we see something too strong, then perhaps the market says, well, chances of rate cuts are just getting pushed further and further away. If we see something too small, then perhaps people start to think that maybe the economy is slowing down. So once again, we need a number somewhere in between, something just right. Next chart we have actually is on real gross domestic product, GDP, out of the US, again, 1.6%. And you can see a nice fall from where it was in Q3, Q4, and now Q1 here in 2024. Definitely unexpected. GDP slowing down. Keep an eye on that. If we continue to see growth slowing in the US, getting closer to that flat line, perhaps that is a signal for the Fed, and perhaps the Fed should take a look more at the slowing economy, why it's happening, and maybe consider interest rate cuts sooner than later. Not sure, but definitely GDP is a signal to investors and one that should be watched. Another economic point or a piece of data that came out recently, something I don't talk about often, and it's the employment cost index. And we have a chart on that. Now, the employment cost index, pretty simply, is the cost that employers face. So primarily wages, wage increases. And you can see how in the far right-hand side that the employment cost index has gone up. It actually went up this last reading unexpectedly higher than anticipated. And on that day, we saw the market sell off. I think the Dow was down 400 points a couple of days ago. The NASDAQ was down because wage inflation is something that's obviously very real and keeping the overall inflation rate from falling significantly. So wage inflation coupled with services inflation, people are spending money today on experiences, and that's keeping inflation high in certain parts of the economy, and it's keeping the Fed from raising interest rates. So overall, what do you need to be looking at? Well, as I said, you want to be looking at the economic data, so the macro part, the corporate earnings, which is more micro in nature, and you want to listen for what the Federal Reserve governors are going to be saying over the next couple of weeks so that we can understand if an interest rate cut is perhaps coming down the road this year or maybe even pushed off to next year. And I think if you factor in those 3 points, you hopefully will get more of an understanding as to how you should build out your investment portfolio today. So taking stock of the economy and the markets, thought we would just run quickly through where we stand today. After the first quarter in 2024, NASDAQ was up 9.5%. The S&P 500, the broadest index for the markets in North America, was up 10.5%, and the Toronto Stock Exchange was up about 6.5%. Well, the month of April has come and gone, and unfortunately, it was one of the worst months we've seen since September 2022, actually. And was it expected to be that weak? Probably not. April historically is actually a good month when you look at it on the chart, on the calendar. April tends to be a good month, and unfortunately, heading into April, my opinion was the market was coming in so red hot that it made sense that investors took some profits off the table based on what was going on in the world, the geopolitical events, the interest rate situation, etc. So April, unfortunately, has given back a little less than half of the returns we made for the first quarter of this year. And we have a chart here of the S&P 500, and the S&P 500 clearly shows this. You have the top point in April and a bit of the start of April, the end of March, and you have it sort of sliding down in the month of April. And at least towards the end of April, we saw a bit of a tick higher there. But overall, when you take stock of where things are at, we're definitely not too far from the high, maybe about 5% off the highs on the S&P 500, maybe just a 2 or 3% off the highs on the TSX. But overall, things are a little bit cheaper, a little bit more affordable if you're looking for stocks to own on these indices. We also saw Canadian economic growth fall. We have a chart on that. We saw it fall. Recent reading is 0.2%, coming off a 0.5% reading in January. Yes, 0.2 is in February, a long time ago. March is looking to be maybe not so much better, and so a lot of people are taking down their expectations for full year growth in Canada because of these weaker numbers. So again, came in after the first quarter, saw strength. Now we're seeing a little bit of weakness. We're seeing a little bit of weakness in growth on both sides of the border. GDP, as I mentioned, in the US down to 1.6. We're seeing some weaker GDP numbers as well in Canada. Some of the areas that worked in the first quarter and worked last year, number one, technology. Maybe they're not working as well anymore, at least for the month of April. And we saw tech stocks pull back for the most part in general during the month of April. We have a chart here, the QQQ, Invesco QQQ, which measures technology primarily. And you can see, look at that fall off, that big fall off towards, I would guess, middle of the month. We saw a big decline in tech stocks, rebounded towards the end of the month, but nowhere near where it was at the beginning of April. And so tech stocks have been probably most responsible for a decline in the overall markets. And as I mentioned, I think on my last show, NVIDIA, we have a chart on that. NVIDIA made up half the gains in the first quarter. So half the gains of the stock market in the first quarter. So when you see the stock market pull back, of course, who's going to pull back? Well, NVIDIA has pulled back. Again, good news, second half of April, we saw a bit of an uptick, but NVIDIA still sits about $100 a share, more than $100 a share. I think it reached around $975 at one point, below its 52-week high. So what worked in the first quarter of last year, what worked in the first quarter of this year, what worked all of last year, has slowed down in the month of April. And now I guess we're going to see how the markets fare in May. Will we see a rebound in tech? A lot of tech companies, as I said, reported fantastic earnings, but they just don't seem to be moving a lot higher at this point. So let's see what the market brings. But overall, it looks like when you take stock of where the market's at today, things are definitely slowed down. And I think investors need to be mindful of this. Should you be a seller because of this? I'm going to say no. I think there's still a lot of investment ideas that you can look to that will continue to grow, but I think you have to be very careful and do your homework, especially when you see the economy starting to slow. So as I mentioned, US GDP dropped more than expected, and from about 2.5% was the expectation down to 1.6%. And we have another quick chart on that. We can show this. We've seen this chart already, a bit of a different chart this time, but it shows GDP falling, and it also shows you to the right what the expectation for GDP is for the rest of this year. Then we have a chart which I wanted to show you on inflation, consumer inflation in the US. And you can see here that inflation has kind of been flat, slightly higher in the last little while. Inflation rate, core CPI, core inflation 3.8%, and overall headline inflation 3.5%, up from about 3% a few months ago, back, I believe, in January. And the reason why I wanted to bring up inflation and GDP or growth falling, whenever we have slowing growth and higher inflation, you can't help but to hear people starting to talk about this one word called stagflation. And we talk about stagflation every now and again, and it's the term that is used or coined for describing slow growth with high inflation. The last time we saw the example of this really wasn't until, well, you got to go back to, I think, the 1970s, when we had a spike in oil prices, which caused inflation really to go higher, and growth was feeling the effects of higher oil prices, among other things. So people are starting to talk about, will we have stagflation in the economy in the US? And I'm not about to say that stagflation is here as yet. 1 month does not make a trend, but it is definitely something to keep an eye on. And if we continue to see inflation, I guess, move higher, and we continue to see GDP fall, that's going to present a big problem for the Federal Reserve, because you just can't cut your interest rates and get out of this situation, because the more you cut rates, the more inflation can move higher. Yes, you could see growth, but you will also see a growth in the inflation rate. If you raise rates to bring down the inflation rate, well, that will hurt growth. So it's very hard for the Fed to maneuver when you have a situation that we could see, hopefully not, but you could see the United States in, which would be a stagflation situation, low growth and high inflation. So let's keep an eye on the growth numbers out of the US. Some people are saying it's a one-off and that we should see GDP back above 2% at the next reading, the next monthly reading. I hope so. And the hope is that we should see, as the year goes on, many people are predicting inflation to fall. So what we want to see, better growth, lower inflation versus the opposite. So keep an eye on GDP. It fell recently, but something that I think the Fed will keep an eye on going forward. I want to talk a bit about this notion of companies reporting good earnings and still seeing their stock price fall. And a lot of clients are, they're baffled when they see this. A lot of investors in general are baffled when they see this type of thing. And I called it right off the top of the show, you buy into the rumor and you sell the news. So you buy the stock thinking that they're going to report good earnings. And then once they report good earnings, basically investors say, okay, well, we got what we were looking for, and you take some profit off the table. And so there have been a number of companies that unfortunately saw their stock prices fall once they reported earnings, and some of them for really strange reasons. The first chart we have here is one on Meta Platforms, formerly Facebook, and you can see the drop off in share price of Meta after they reported a quarter that was fantastic. Growth was unbelievable. There 3.2 billion people are on Meta apps every single day. There's only about 8 billion people in the world. I know I keep telling you that stat, but it's just a phenomenal stat. And when they said that they're going to be spending more and more money on artificial intelligence, their own chips, their own programs, that the market didn't like that. And they said, okay, well, you're spending more money. Your costs are going to rise, and the stock sold off. I think personally that, I guess, investors kind of had deja vu with the stock with respect to their earnings release, because we heard similar story when Meta said they were going to spend billions and billions of dollars on the metaverse. And we know what happened. Individual investors did not like that, all that spending, and so they sold the stock off tremendously. Well, this is obviously very different, and the metaverse really hasn't materialized as yet, at least to the degree that I think the CEO, Mark Zuckerberg of Facebook, had envisioned. But AI, I think, is here now and very real. And just with our interview with Bob Tapscott telling us how it's going to revolutionize the way we live and do business. So the idea that Meta is spending all this money on artificial intelligence, in my opinion, is not a reason to sell the stock. So I believe a name like Meta, for those that can handle the risk, may be an opportunity for some that want to buy the shares here, because this stock was well over $500 a share, and now it's in the 400, 430, 440 range. So name like Meta, definitely investors sold when those results came out. And they sold based on spending. And we've seen a lot of spending. And we heard Google talk about a lot of spending in AI, Microsoft, a lot of spending in AI. But for some reason, those companies were able to get away with higher spending, whereas Meta, perhaps because of its history, was not. Another name that was sold off based on earnings, and we talked about this, I think, on our last show, was JP Morgan. And we have a chart here. This chart I wanted to show because JP Morgan, again, like Meta, sold off, but has recently come back almost to its prior highs of about $200 a share. So will Meta do the same? I think it may. When cooler heads prevail and everybody sees that Meta is doing what they should do to advance their business, to do well in a world where AI is becoming more and more prominent and spending in the right areas, perhaps Meta has the same chart down the road as JP Morgan has. And we saw the dip after earnings and a rebound shortly thereafter. So just because a stock sells off after earnings, it doesn't mean the earnings were bad. You really have to do your homework, study, listen to the conference call, listen to what the CEOs are saying, understand what they've reported. Is it a good report? Is it something that is promising for the future? What are they saying in the quarters to come? Are they upgrading? Are they increasing what they believe they will make? This is meaning the companies. Will companies increase or announce increase in earnings going forward? Or are they saying that they're in tough going forward? So listening for what corporations are saying at this time when they're all talking about their latest earnings is extremely important. And don't get boggled down in case a stock does sell off after earnings if it's really being sold for the wrong reasons. So you really have to do your homework and don't get too worried if a stock sells off and the old adage, buy the rumor, sell the news, takes hold. So I thought I would touch again on the budget that was released a few weeks ago by the federal government in Canada. We touched on it very briefly last show because we didn't have much in the way of details. Well, now we have a lot more details. And I want to show a couple of charts right off the bat. The first one, tax fairness for every generation. And it's the first chart we have here. I wanted to show this because you can see what the government is saying, the top part of this chart. Government is saying that capital gains does not make up as much. Wages and other income make up the bulk of what people make. Dividends makes up a small piece, but capital gains is far less than wages and other income. And towards the bottom of this chart, and it's difficult to see here, it basically shows us, the government is telling us that by them increasing taxes on capital gains, and this is the biggest beef that individuals have, whether you're a doctor and incorporating, whether you're a small business, or whether you are someone that has many investments that earn capital gains tax. This is where I guess the difficulty and the anger for some investors and small business owners comes because the government is saying that the rise in the inclusion rate. So basically, let's say you make $100 capital gains on an investment. Up until June 24th or currently, 50% or $50 out of that 100 will be taxed at your marginal tax rate, and $50 or 50% will be free and clear in your pocket. Well, going forward, for those that for the year have more than 250,000 of capital gains, you're going to be taxed on capital gains at 67% of that capital gain. So again, you make $100, 67% of that $100 will be taxed at your marginal tax rate versus just 50%. So for those watching today, you're saying 250,000 of gains, that's only for the real wealthy. Well, that may be true. However, all the gains that come up inside of a corporation, inside of a trust, are going to be taxed at the 2/3 rate. So again, if you have a capital gain inside a corporation, you're going to pay 67% of that capital gains tax at your marginal tax rate, or the corp's marginal tax rate. So that affects a lot more than what the government has told us it would affect. 0.1% of the population is what the government told us. That's not true, in my opinion. It's going to affect a lot of people. I know doctors are up in arms. Other professionals are up in arms. Many small businesses are up in arms because many professionals and small businesses invest in their business. We already have a productivity issue, according to the Bank of Canada, in this country. So why would our government increase capital gains tax on individuals or businesses and prevent them from investing more in their business, investing more in the markets, investing more in real estate, investing more in the things that we need people and businesses to invest in to make our country function at a higher productivity rate? And so many people just don't understand, including myself, why you would bring a tax. Now, government will say, we're just taxing the wealthy. The wealthy need to pay their fair share. Well, I know, talking to a lot of investors, the wealthy pay their fair share. They are responsible for most of the tax revenue that CRA takes in. So many people are very upset at the increase in the inclusion rate. And we'll see if this budget gets passed or not. There have been some rumblings that the increase in capital gains tax is not part of the overall budget, that it'll actually be something that gets put through on its own, to be voted on its own afterward. So we'll see what happens. But overall, I guess my commentary on the budget is there are a lot of upset people about the increase in inclusion rate. And I think that's something that, in my opinion, the federal government needs to address. Now, the part of the show that I like best, as always, to answer a few questions from our audience. And I know our show is running a little longer, as always. Whenever we have a guest, we always have a bit of a longer show. So thought I would take at least one question today. And here we have. First question here. Do you think that the new capital gains inclusion rate will affect the markets? Will lots of people be selling assets in their portfolio before June 25th deadline? So perfect question. I know a lot of people are talking about this. I would say yes, there may be a number of individual investors that will realize their capital gains before June 25th, especially if you're investing in a corporation or through a corporation or a trust. However, keep in mind one thing, and I've talked to a few investors about this already. If you are going to sell because you need that money for something else, then yes, it obviously makes sense to sell before the June 25th deadline. However, if you are going to sell just to reinvest that money back into the market or into real estate or somewhere else, then obviously it doesn't make sense, because yes, you may realize that capital gain, you're going to have a capital gain, but again, once again, at some point down the road, you're going to have to pay the higher tax. So unfortunately, if you realize that capital gain today, you're paying 50% tax. That may, if you realize all these gains before June, it's going to possibly put you in a higher tax bracket. So there could be a lot of issues realizing that gain before June 25th. Will some people do it? I think they will. But in my opinion, I think you have to take it on a person-by-person basis, or a corporation-by-corporation basis, trust-by-trust basis, because all trusts, corporations, individuals will be at different levels of income. And I think that's something that definitely you should speak to your tax specialist about, your accountant about, before you make any investment decisions. Also, obviously, speak to your investment advisor as well. So I want to thank everyone once again for joining us today on the show. Again, as I said, a lot of great information. I guess, if you've taken anything from the show, hopefully you've been able to take something regarding the Fed or interest rates or taxes or the budget. I think there's lots there to go through. So again, I want to thank everyone for being on the show. Please join us again 2 weeks from today, May the 15th, and we will be talking about, obviously, the markets and what you need to know about investing before you make your investment decisions. So until then, happy investing.